beyond the initial gathering of the funds and signing the PPM on these deals, there's really not much else to do other than just send people their distribution every month or every quarter or whatever. People get into this because they want it to be passive.
Right.
So the investors aren't trying to heckle us every month or.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Brian Davis first came on the show on December 6, 2020. Brian, you were kind enough then to take a gamble on coming on this show. You were actually, if I can even speak today, guest number 7. Number 7
Oh, wow.
on the show. Yeah, I know. When this goes live, you'll probably be guest number 775 or 800, somewhere in that neighborhood. So it's been a while since you've come on the show. If you want to go back and listen to that episode, you can learn a lot about what Brian was doing then. That's 2 years and 1 month ago, almost, actually a little more than that, since we last recorded an episode. Brian, normally I give the intro of the guest, but if you don't mind, just tell us what, a little bit about yourself if you can.
Sure. Well, thanks, Sam, first of all. So yeah, my name is Brian Davis. I am a co-founder of SparkRental.com. Our mission is helping middle-class people build passive income from real estate and go off and live whatever kind of life you want to live. So, for me, that's traveling around South America for most of the year with my wife and daughter. But for other people, it's something else. So that's the 2-second or the 2-sentence overview.
I love it. Brian, there are 3 questions I ask every guest who comes to the show, and you probably answered these 2 years and 1 month ago. But again, we'll see if we get a different answer this time. Where did you start? Where are you now? And how did you get there?
So I started as a loan officer doing hard money loans for real estate investors right out of college. I kind of fell into that job by accident, as so many people do with their first job. And I saw all these people that we were lending money to making money hand over fist in real estate. It was back in the bubble in the mid-aughts. So I was like, I got to do this too. So I went out and I bought a bunch of rental properties. I was living really frugally at the time, so I was saving money, and I bought, I don't know, 15 some rental properties, and then went off and worked for an online landlord software company for a while. Moved across the world, got married, and then promptly lost that job right after getting married and moving across the world. Without any support network or any of that. I had this new wife who was wondering, what she had gotten herself into with this bum. So that was kind of how Spark Rental got born. My former colleague and I got together, and we wanted to create a company geared towards mom and pop landlords, small real estate investors, people who were looking to build passive income from real estate. So we've built out a whole series of tools, from software tools, landlord property management software tools, to calculators, rental cash flow calculators, interactive maps showing, real estate heat maps around the country, and free courses, free videos, free, podcasts and articles and all that stuff. And the most recent thing that we've launched that we're super excited about is a co-investing club where we all get together once a month. We vet a real estate syndication deal, and then we pool our funds together to all access it. So
there's a disconnect for me. All right. So you lost 15 houses, whatever it was. One, I want to hear, and maybe you talked about this 2 years ago, but I've slept since then. So forgive me if I've asked the same question. I want to hear how you lost them. Like, what do you feel like were besides the economy went to garbage? Like, what actually happened that you were unable to retain ownership of those properties? And then 2, what gave you the connection later on that said, hey, wait, I flopped miserably, but yet I do still think there's merit to what I was doing, and how you came to that conclusion and then started Spark Rental?
So I bought properties not really knowing how real estate cash flow worked, not understanding that you have a lot more expenses than just your mortgage payment and property tax bill and landlord insurance premium. I have since learned rules of thumb like the 50% rule that state that, you're going to end up losing about 50% of the rent towards non-mortgage expenses, things like maintenance and repairs and capital improvements, vacancy rate, property management costs, all that stuff. So that was one problem, is that I went into it kind of cocksure, as a someone in my early to mid 20s, thinking, oh, I don't need a mentor. I can figure this out on my own. How hard can it be? I think we've all made some of those mistakes in our lives. Mine was a little more expensive than the average person's. But so that was one problem. Another problem is that because I overpaid for these in the bubble, I couldn't just sell them once I realized some of my mistakes here on the cash flow side. I realized that I was negatively cash flowing on the bulk of these deals. But because the market had taken such a dive, I couldn't actually sell them because I was underwater on those deals. And then the third problem was that I had bought in very low end neighborhoods in Baltimore City, which during the aughts and during that housing bubble had actually looked promising. A bunch of New York capital and DC capital was flooding into Baltimore at the time. All those Baltimore rental properties looked like such great bargains to DC and New York investors who were well heeled and had deep pockets and whatever other wealthy metaphors you want to use. So all that money dried up overnight, basically in 2008. And that was a big problem for those neighborhoods, for people like me who had invested in those neighborhoods. So those were my mistakes that I made early on in my real estate investing career. So for the audience members out there, I hope you don't make those same mistakes. I hope you learn those lessons the easy way, from someone else making them. So I didn't lose those properties per se. I sold them off over the years, mostly taking a loss on them. Some of them I made money on, but by and large, it was pretty painful.
Right.
I did keep investing though. I changed my strategy some. I went out and bought my own personal residence, but I had not before leading up to that point. And house hacked, I brought in a housemate who covered most of the mortgage, and then I kept that property as a rental for a while. I actually ended up making mistakes with that one too, but it had a beautiful view of a marina in Baltimore's Inner Harbor from a rooftop deck, which was the huge selling point. When we moved overseas, we kept that property as a rental, and then someone built a big addition in front of us and blocked the water view while we were gone. Mistakes to learn from. And nowadays, I mostly do passive investing. I still do a little bit of active investing, but mostly I invest passively in syndications. I spend most of the year overseas. I spend about 10 months of the year abroad, and I just don't. We run a company full time. I still do a little bit of freelance writing on the side. I don't have time to babysit investment properties back in the US. So I'm on board with the passive investing train.
I'd love to hear a little bit more in depth what kind of brought you to where you are now. I know you guys are investing in syndications. I want to kind of hear about the way you're structuring it, how and why you're structuring it, the people you're bringing in. I mean, just give us the down and dirty on kind of your whole business model and approach right now, if you don't mind.
Yeah, absolutely. So we have created online courses for real estate investors for years now. And for a long time, they weren't selling very well, and we couldn't really figure out why. We saw plenty of other people selling courses on similar topics. We felt that our courses were just as good as theirs, and and people kept telling us that they were interested in building passive income from real estate, reaching financial independence with real estate, lifestyle design, these sorts of things. And what we came to realize, or at least the thesis that I had, which I stand by, is that people don't necessarily want or need more information. In today's world, information is abundant, and that doesn't mean that there's no place for online courses. There certainly is, but people really want the results. So if you're trying to differentiate an online course, you need to go beyond just information in the form of videos. And what we decided to do was to launch a co-investing club, is what we call it, for our course members, where once a month we propose a real estate syndication deal to the club members, and whoever wants to participate can. We get together on a big video call. We bring the sponsor of the deal on the call to grill them and ask them a bunch of questions about the deal. And then whoever wants in can invest with as little as $5,000 in that deal, making it a lot more accessible than the $50,000, $100,000 typical minimum investment for these deals. So we look for sponsors who allow non-accredited investors because our target audience is middle-class investors. Our whole mission is helping middle-class investors get over that hump, right? And access these sorts of deals that have historically just been reserved for the wealthy. So we go out and we do a lot of networking and try to find reputable, high quality sponsors who allow non-accredited investors. But even for your typical non-accredited investor looking to get into syndications on their own, it's really hard to do because the minimum investment is so high on these deals. $50,000 for some, occasionally 25, but just as often $100,000 on these deals. And that's hard for a middle-class person. And even if they have that kind of money sitting around, it makes it hard to diversify, right? I mean, you can only buy one in every blue moon, so that is really how the co-investing club was born. We wanted to make it easy for middle-class people to access these. We wanted to make it easy for them to diversify and invest in a bunch of these so that they have their money in different properties all over the country with different sponsors in different niches, from multifamily and also self-storage or mobile home parks. Or we really want to add that diversification component. So that is really what we're doing for our course students that is so different than what everyone else is doing out there who's selling courses about real estate.
Tell me about the structure of that, because that sounds like it could get complicated. Are you just saying, hey, here's a cool sponsor, hey, here's our group of limited partners or potential investors, and you guys now go off to the races and have a good time? Are you guys setting up individual LLCs that then are investing with that sponsor? How are you structuring this? And then if you can also speak, well, let's just start there and then I'll
Yeah, because there is a fine line to walk there legally, right? From a regulatory perspective. So we are not selling securities. We are not raising money on behalf of these sponsors. Obviously, that would be a big no-no. We don't take a cut on any of these deals. We propose them to the club members, and we pledge that if there are enough people interested in a deal, we will also invest some of our personal money in that deal alongside them. But yeah, we don't get a cut. We're not trying to sell securities or anything like that. We are simply investing alongside them and helping to propose these deals for the entire club to then collectively vet together. So, like I said, we all hop on a video call once a month. We bring the sponsor on and we all, we grill them. We talk through the deal, pros, cons, risks, rewards. So yeah, we are walking a little bit of a fine line there, but we are simply investing alongside them as equals in these deals. So we're not taking a cut or anything like that.
You're not forming an LLC that then becomes a single check investor. Then
we do, but that is simply as a group. I mean, so we form a joint LLC, we form a joint bank account. Everyone gets access to it. Everyone who's a member of the LLC gets full access to all the banking and the transaction history and all the legal documents and all that stuff.
Got it.
So if anything, we're first among equals, but we're not organizing this. We're not trying to pitch it or raise money as a security or anything like that.
Have a deal, right? And we're raising $10 million, and I'm confident that my group, within my network of sponsors, can raise 9 million of it, and I'm going to go out to some other, friends in the market and say, hey guys, do you want to be part of this deal? And you say to me, hey Sam, yeah, I think we can form an LLC, and I think we can bring X number of dollars from our investor base. How do you do that before? What's the flow look like on that?
So first and foremost, we go out and we talk to the sponsors to get on their mailing list in the first place, right? Because they have to have an existing relationship with us. Since we're working with people doing 506B deals that allow non-accredited investors, they have to have a pre-existing relationship with all of those investors, including us. So we sit down with the sponsors and just talk to them about what they're doing, what we're looking to do, our investing goals, their investing goals, and then we get on their email list. As they have deals come down the pipeline, they send an email blast out. My partner Danny and I will review those deals, and any that we think are a good fit for the co-investing club, we will send an email blast out to our members, our club members, and say, hey, this is a deal that has just become available. We're going to sit down in 2 days from now, with the sponsor to ask some questions about the deal. If you can make the call, great. If not, we'll send out a recording of it afterwards and a summary. Here's the investment slide deck showing the full details of the deal. Usually these sponsors will send out a video webinar breaking down the deal as well. We'll forward that on to our club members. And to your point about working with the sponsors and the timeline of it, we have to move very quickly on these because the sponsor needs to know how much we're investing as a club. And since we're trying to wrangle a whole bunch of very, very small investors on these deals, we have to set pretty quick deadlines. So for example, we met yesterday to discuss our most recent deal, and the deadline for people letting us know if they want in is tomorrow. And yeah, so we're moving quickly on these, giving people a very short deadline. And that's, I don't know if you want to call it a drawback, but that is a reality of doing these sorts of deals, pooled together a bunch of really small investors, a bunch of minnows instead of one whale.
I love it. No, that's great. And I think what the niche you're serving there, and I use that word serving, is really important because it is, there are some hurdles. There are just some very real hurdles that particular demographic just, it's tough to get in. It's tough to get in, and it's tough to squeeze 50 grand out. I mean, if you're a middle income or middle class families, 50 grand is not it's not a small amount.
It's not trivial.
No.
I mean, that could be your entire salary for a year.
Could be, very well could be. So I love what you're doing there. One of the reasons that I've heard, and I'm just giving, kind of industry feedback that I've received, when you start dealing with smaller investors, is that the workload to investment is an inverse relationship. So the work goes up and the investment is smaller. How do you protect your time in that? Because $5,000 to one person may be $500,000 to somebody else. So how do you protect and value your own time when dealing and working with this particular set of investors?
Sure. So we use a platform called TribeVest, which helps with some of this. They're relatively new. They're not perfect, but they do have a lot of cool features.
Okay.
And they do make it relatively easy to set up these pooled investments and give everyone totally transparent access to the banking history and legal documents and so forth. So that's one tool that we use. We have not really scaled this up with our team yet to have them take care of creating the LLC and creating the bank account and putting it all together on TribeVest. But that is the kind of thing that a team member or even a VA, a well-trained VA, can do alongside us and do 90% of the heavy lifting on that. So that is a way to scale that. And one nice thing about what we're doing here as completely passive investments is that beyond the initial gathering of the funds and signing the PPM on these deals, there's really not much else to do other than just send people their distribution every month or every quarter or whatever. People get into this because they want it to be passive.
Right.
So the investors aren't trying to heckle us every month or every couple months. So we have not found that to be a problem yet. But that is, to your point, that is a risk in this. Sooner or later we will probably get a nightmare, a partner on these. But we haven't had that happen yet. So knock on wood.
Good. No, that's great. And I'm glad to hear it. I mean, there have been, at times I can think of one person in particular that a good friend of mine, and he said, hey man, I want to invest. And he kind of told me the dollar amount. And then I kind of knew his methodology and how he handled money and things like that. And I said, dude, no, I love you, but no, it's going to be bad for you and bad for me. So no, I think that's a great answer. And I love the use of technology and some things like that, and maybe just setting expectations up front. Brian, we're out of time. I've got like 12 more questions for you that I really want to dig in. We may have to do a part 2 to this episode, but in light of the fact that we're out of time, if our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Sure. Well, you can reach us through our website, of course, SparkRental.com. We're on all the major social media platforms at SparkRental, or send me an email personally, Brian, Brian, at SparkRental.com. I answer all those emails myself. It's not like I have a bunch of minions running around. So please stay in touch.
Fantastic. Brian, thank you again. Certainly appreciate it. Have a great rest of your day.
Sam, you too. Thanks again for having me.
All right, sir. That's a wrap. Brian, thanks for coming on.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.